Hi, in the last video, we have discussed pricing and the allotment of IPO. After secondary market trading starts, investment banks try to make sure the newly issued stock trades at a price higher than its offering price. If price trades below offering price, an issue is said to be a broke issue, and the buy-side clients of investment banks who spend efforts in book building will suffer a loss. Besides, a broke issue may lead to investor lawsuits. In this video, we will learn about the greenshoe overallotment option, which is often used by investment banks to stabilize market price after IPO. A greenshoe is an overallotment option that gives an investment bank the right to oversell or short sell a number of securities of an offering. The amount of shares for oversell typically accounts for 15% of the offering base of shares outstanding. The word greenshoe derived from the name of Greenshoe Manufacturing, which was the first company to use this mechanism to stabilize market price in its IPO. To enable a greenshoe, an investment bank first needs to get the agreement from an issuer to sell additional shares at the same issuing price within a certain period after IPO. This means if the overallotment option is used, an issuer agrees to sell an additional 15% of shares to its underwriter at the same issuing price. If a greenshoe option is used in an IPO, an underwriter would initially oversell or short sell the additional securities at time of offering. Overselling is short selling in nature because underwriters sell securities they do not have yet, and the number of securities sold by investment banks will be larger than offering base. When secondary market trading starts, share price may either rise or fall. In case of a price fall, an underwriter will buy back the additional shares they oversold in the open market to support market price. If all of the oversold shares were bought back, the greenshoe option is not exercised. Investment banks can also buy back a partial number of shares until market price rises above issuing price. In case of a price increase, an investment bank exercises the option to buy additional shares from the issuer at offering price to cover their short position. And we can see investment banks have no risks in their short position in case of market price increase, because the issuer agreed to sell them shares at a price equivalent to issue price. For example, Alibaba used greenshoe option in its IPO. The offering base of Alibaba was 320 million shares, and its underwriters had the option to oversell a maximum of another 48 million shares, which equal 15% of the offering base. During its first day of trading, its share price increased 38% above its offering price. Thus, the overallotment option was exercised, and Alibaba eventually issued a total number of 368 million shares. Greenshoe option provides issuers the flexibility to adjust the amount of shares issued according to market demand. In case market demand is hot, an issuer can issue more shares when the overallotment option is exercised. The use of greenshoe option can also increase underwriters' income. In case of a price increase, the sale of another 15% of shares generates additional fees for investment bankers. In case of a price decrease, investment bankers buy shares in the open market to cover their short position. Because share price is lower than issue price, investment banks can make profit from its short position. Okay, thanks for watching. In the next week, we will have a further discussion on how investment banks may help an issuer raise funds through financing instruments other than stocks.